very good friends with Steve Feldman, who runs Gold Billion International. I own gold. I believe in gold as a long-term store of value, and gold has been volatile recently. It got to its all-time high last year, but I mean, gold's a $30 trillion market cap. There's no reason why it couldn't be a $60 trillion market cap over the next 10 years. It's just, I think gold is going to be part of the future. Now, we were talking about dollar supremacy or the hegemony of the dollar. If that should wane, gold is a really good hedge against something like that.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Scaramucci doesn't just casually favor Bitcoin, he calls it his best investment by far. His reasoning is rooted in both historical patterns and structural trends. First, he points to the Bitcoin halving cycle, a recurring event that reduces the supply of new Bitcoin entering the market. Historically, Bitcoin tends to experience volatility and corrections in the second year of this cycle, and according to him, that correction has already occurred. That suggests one thing: the asset may now be positioned for its next upward phase. He also compares Bitcoin to high-growth private investments like SpaceX. While acknowledging that companies like SpaceX may deliver strong returns, he notes that their future public valuations will likely already reflect much of that growth. Bitcoin, on the other hand, may still be underappreciated. For Scaramucci, the conclusion is clear. Bitcoin represents a high upside opportunity in a market where many assets are already priced to perfection.
Yeah, a lot of things look expensive here right now, but there's one asset that is down 40% relative to the move in the S&P 500 since October of 2025, and that's Bitcoin. And so when I look at the asset landscape, things look very, very expensive, but on a relative basis, Bitcoin looks cheap on a relative basis. I think SpaceX and Anthropic, as they eventually go public, they'll probably be at pretty high valuations. Not saying they won't go higher, but it'll take some time to digest that. Bitcoin, I think, is going to provide people with a big reward because it's been correcting pursuant to the halving cycle. It typically corrects in the second year of the cycle, and we've had that correction already.
So what's the best investment you've ever made? Was it Bitcoin?
I would say by far it's been Bitcoin, yeah, by far. I mean, I have an investment in SpaceX, but it's a very small investment. I mean, that's probably a better investment. I mean, if I put $1 in Bitcoin and $1 in SpaceX, the SpaceX has gone up on a multiple higher than Bitcoin, at least for now. Very good friends with Steve Feldman, who runs Gold Billion International. I own gold. I believe in gold as a long-term store of value, and gold has been volatile recently. It got to its all-time high last year, but I mean, gold's a $30 trillion market cap. There's no reason why it couldn't be a $60 trillion market cap over the next 10 years. It's just, I think gold is going to be part of the future. Now, we were talking about dollar supremacy or the hegemony of the dollar. If that should wane, gold is a really good hedge against something like that. It's possible. If the Americans decide that they're going to lose their complete discipline, I think with somebody like Kevin Warsh at the helm of the Federal Reserve, I think he's going to be a great Federal Reserve chairman. And I think that happened about 15 years ago, and then it corrected back. And it's happening again right now. And I think with a good chairman, which Kevin will be, I think we can correct it again. But it's possible. And that's one of the reasons why I own gold. Let me tell you, there's a lot of scenarios that are great for the dollar where gold doesn't lose a lot of value. It's just a good store of value. And there's a lot of scenarios where the dollar's not doing well, where gold goes exponential. So I think gold has the facets of good downside risk protection with very reasonable upside, depending on the facts that unfold.
Broadly speaking.
Listen, we're up a lot. We've already moved a lot. We've had 5 weeks of gains, okay, and this is surprising to a lot of people. And guess what's going on? There's shorts in there. Remember, the market climbs a wall of worry. And so everything that you and I are talking about, there's a group of people that are saying, this can't be right. This is going to be a colossally bad thing. And so they're short the market. So guess what happens? As the market's rising, they have to rush back into the market to cover their shorts, which creates even more market momentum. So I don't know. If the war gets resolved, we're probably going up another 10 or so percent from here. Some of the stuff will be overpriced for sure. The market is actually, the market, if you look at the metrics that Paul Tudor Jones uses or Warren Buffett, the market's at 250% of GDP. So that signals to us that it's overpriced. But yet, if you look at the earnings, if you looked at the record earnings at Goldman Sachs, record earnings at some of the tech companies, record earnings at Bank America, you would say, okay, the markets are delivering the earnings. And so this is the reason why the markets are buoyed. So I think it's 2/3 chance the market goes up 10% from here. You have a pretty strong positive back end to the year. And there's 1/3 of a chance that things go haywire. And the Fed is put in a box due to the energy crisis and the fertilizer crisis, et cetera. And they can't cut rates. And if anything, the war goes on way longer than we all think, and the market has a 20 to potentially 30% decline. Those are the two outcomes here.
This crisis is different, right? When you hit the wall and you're trying to issue treasuries, and the Fed is the only buyer, and the prices of the treasuries are going down, and interest rates are up, that's a dangerous thing. And so the thing I am talking about now is, we know, people say, when are you going to hit the wall? I obviously don't know. It's impossible to know. But the law of economic gravity, you're not going to know that. So, and when we hit it, it will be vicious. So we have to prepare for that eventuality. And I think we need an emergency break the glass plan, which is targeted and short-term on the shelf, so it's ready to go when we hit the wall.
Well, first of all, I love him. I worked for him. He was the principal architect of bailing us out of the last crisis, and so I think we should heed him. We should listen to him. I think it's on point in the sense that the $38.9 trillion, I actually looked that up while he was speaking. So just give you the total debt, right? So our GDP is 31 trillion. Okay, debt outside the country, 31 trillion, but our total debt, 38.9 trillion. That is a very big number. And if the Fed is forced into being a buyer of last resort, you could see a scenario where you have to take their balance sheet up to 15 trillion. Okay, and so what I would have loved to have heard Hank say is, yes, we need a break the glass strategy, but hello, congressman, and hello, people that are lobbying the congressman for all the moolah. Either you got to tax the people more, okay, or you got to spend less, or you got to slow down the spending. So yes, we need a break the glass plan, but I would recommend that we need a 10 or 15-year plan to slow down the spending. And Michelle, I could take you back, and probably don't have enough time in this interview, but viewers and listeners could Google pay-as-you-go legislation, which was put in place by George Walker Bush's dad, George Herbert Walker Bush, and Bill Clinton adhered to it, and they ended up running a budget surplus at the end of the 1990s. And so what was pay-as-you-go? It was just guardrails. You can only grow the government budget this much. If you want to increase spending, you had to concomitantly have a tax increase. If you wanted a tax cut, no problem. Then you had to find something in the budget to cut to offset the tax cut. We don't do that anymore. We're running this thing on what's called a continuing resolution. We don't have any formal budgets anymore. And these governmental agencies are growing 5-6-ish%. If they grow at 2%, Michelle, they announce that they've had a 4% budget cut. And all it was a slowdown in the growth. You know, these governmental agencies and these budgets never really get cut. So to me, I think it's a combination of things. And we've got the need for Social Security reform, closing some tax loopholes. There's a lot of things we need to do. It's not just, hey, let's have a break the glass moment and figure out how the Fed can own more treasuries. Guys, slow down the spending.
One of Scaramucci's most serious concerns lies in the long-term fiscal health of the United States. With total debt approaching $39 trillion, the U.S. faces a structural challenge that cannot be ignored indefinitely. While the country possesses enormous assets, potentially worth close to $100 trillion when including land and resources, the trajectory of spending remains unsustainable. He warns of a scenario where the Federal Reserve becomes the buyer of last resort for government debt. Interest rates rise, confidence in U.S. fiscal discipline weakens. This could eventually trigger a sovereign debt crisis. His solution? Not just emergency measures, but long-term discipline. He advocates for a return to policies like pay-as-you-go, where government spending increases must be matched by either higher taxes or budget cuts. Without such guardrails, he argues, the system drifts toward excessive borrowing and ultimately inflation.
Not yet. And remember, deeply analyze the debt. The United States owns 28% of the land, meaning the U.S. government owns 28% of the physical geography of the 28% of the physical geography of the 50 states. So underneath that is a tremendous amount of mineral resources, oil, etc. We have a balance sheet that's probably worth close to $100 trillion if you were to size up everything on the U.S. balance sheet. So the 37, 38, $9 trillion worth of debt is not a wipeout yet. But if you tell me we're 15 years from now and we haven't solved for any of the problems that you and I are discussing, I think you're in big trouble. I think, guys like Hank Paulson and Ray Dalio will be looking around saying, wow, we could be in a sovereign debt crisis that the U.S. is not planning for. And I don't know if you spend any time in Washington. I was in Washington for 11 days. I get fired, and every time I go to Washington, I break out in a hive. So I'm not the best guy to go to Washington. But when I am in Washington and talking to these people, they don't care. $1 trillion here, $1 trillion there, $1 billion here. The spending has gotten wildly out of control. And you know what happens? Milton Friedman said it better than me. So let me just quote him on your show. Milton Friedman said, deficit spending is unfunded tax liability. And so if you're not going to tax the people, you end up coming up with the most pernicious and most regressive form of taxation, and that's inflation. And so they start to monetize the debt by weakening the purchasing power, and that hurts the people that don't have the assets. That's why we're seeing this big general unhappiness of the wealth effect. If I own the assets, my asset's going to go up in price on nominal dollars. But if I'm just a worker, Michelle, and I'm losing purchasing power, you're taking my time and energy away from me. You're stealing a portion of my life, and it gets people really upset. I think the tribalism, I think the political quagmire that we're in, where we can't come up with plans that make long-term sense for the United States. The Chinese, which I would say is an economic competitive adversary at this point, has 10, 20, 30-year plans for their growth and their development. We don't. We need a 15-year infrastructure plan. We need a 15-year K through 12 public education equalization plan where people all over the country can get a good education. We need a deficit spending reduction plan over a 10 or 15-year period of time. And so what happens in the country, we have 2-minute plans, or we have cable news segment plans where we bash each other, or we're running for a 2-year reelection or 4, or if you're in the Senate 6. It's not workable anymore. We need transformative leadership where somebody get to a microphone like the one I'm speaking to you on and saying, look, here is the problem and here are practical solutions, but you're not going to like them. You said something 5 minutes ago, which I unfortunately agree with. You're like, yeah, Anthony, that sounds good, but that's not going to happen. And I'm looking at you and saying, Michelle, you're right. That's not going to happen. So at some point, though, maybe people will wake up. I would imagine if you met a politician or one that came on your show that articulated something that you agreed with, maybe we could create a groundswell or a movement of people that would say, yes, we have to make these short-term sacrifices for the betterment of the country. I'll say a couple things, and I want people to really think about this long-term. I see it as a short-term problem, as Mike and I discussed. You saw a 10% drop in jobs at Meta, as an example, meaningful drop. Some of these companies are using it as an excuse to lay people off, even though they haven't really put into practice the AI productivity reforms that they were suggesting. They're still laying the people off in order to save money. So I see it as a short-term thing, but I see the productivity that AI is going to unleash as a positive. And as I mentioned on that podcast, I do think there'll be a robot tax. And I think there will be a tax on AI and AI services. And I think there'll eventually be some form of universal income. I do think that will happen, and it will cause a buffer zone. There could also be, which people are looking at, Michelle, wage insurance. So let's say I lose my job. There's supplemental wage insurance that kicks in while I'm looking for another job to sort of buffer the transition. So I will say this, it's a scary time because we're talking about displacing 20% of the mid 40, early 50 white collar jobs in the country. And so that's going to create a lot of economic anxiety, and it's going to create a lot of political tumult because you want to watch politicians get beaten up, just get these soccer moms angry at them, okay, and watch how they handle it, So for me, I'm worried about it, but I think it's going to be offset by the gains. And so I think this is sort of short-term stuff, and I'm old enough to remember when the phone companies were going out of business. Long distance phone was $3 a minute in the 80s, $2 a minute in the 90s, 50 cents a minute in the early 2000s. Now it's no cents a minute. And people said, well, the phone companies were going to go out of business. But what did they do? They continued to innovate, and they continued to find ways to make money, whether it was in cable subscriptions, Wi-Fi subscriptions, data transmission hubs, and highway systems, information highway systems. And I don't want to bet against human ingenuity by suggesting that everybody's going to get displaced. I think the first piece of this is learn how to use the AI to make yourself more productive. There was a great saying, I think it was from the dean from the Yale School of Management, Jeff Sonnenfeld. He said, the AI may not replace you, but who could replace you is the person that knows how to use the AI. So let's get into that. Let's make people aware. Let's give them some job training and make them less intimidated about this new technological wave that's hitting us.
While bullish on Bitcoin, Scaramucci isn't abandoning traditional stores of value. He maintains a strong belief in gold as a long-term hedge. Gold, currently a $30 trillion market, could potentially double in value over the next decade, in his view. But more importantly, gold serves a different purpose than Bitcoin. It's not just about growth, it's about protection. Scaramucci highlights two key scenarios. If the US dollar remains strong, gold still holds value as a stable store. If the dollar weakens or loses global dominance, gold could rise dramatically. This asymmetric profile makes gold particularly attractive in uncertain macroecon